Hey, what's going on? I've been meaning to make a video about this topic for a little while now, and it's one of the best kept secrets in the real estate investing world. And I'm going to share that secret with you today. This underutilized strategy is called a cost segregation study. And cost segregation is a strategy that allows real estate investors to utilize accelerated depreciation, which helps increase cash flow and reduce taxable income. This is done by breaking down and reclassifying certain interior and exterior components to a building. Typically, this is done over the course of 39 or 27 and a half years for commercial and residential properties. But for a cost segregation, these are reclassified into what I like to call 5, 7, or 15-year buckets of time. So, what does all that mean for you? Well, to simplify it, you're depreciating certain items on a faster timetable, therefore writing it off sooner than you typically would under a traditional depreciation schedule. This means more tax savings sooner for increased cash flow and faster ROI on your properties. Now, I know this might seem a little confusing right now, but let's run through a quick example to illustrate why this strategy is a good fit for most real estate investors. So let's set the stage. For this example, let's say you have a commercial warehouse property with a total property value of $1 million, where $200,000 is the land value. This is going to leave you with $800,000 for the building value. And this is the number that we care about for depreciation, since the land itself is not depreciable for tax purposes. Now, you're most likely depreciating over a 39-year period, but check with your CPA for that. If they're unsure, or if you're not doing that at all, get in touch with me and we can help you get started. Another important factor is your tax rate. Let's say you're being taxed at a rate of 35%. For this example, we're going to use that as a flat rate. And this is going to vary depending on how your business is set up and how much money you make. But let's just use that flat number for now. The last background number we need is the 2.56 depreciation rate. The 2.56% multiplied by 39 years is what gets us up to a 100% depreciation. So that's why that rate is used. Now let's use this information to check out how a conventional depreciation can work for this particular example. Okay, so let's use the background info that we just gathered to run through a conventional depreciation example. Remember, we subtracted out the land value and got $800,000 to start for the building value. Then using the 2.56% depreciation rate and your tax rate of 35%, we can calculate out our deductions. Using the formula for conventional depreciation listed below, we come up with $7,168 in yearly tax deductions, which can be claimed each year for 39 years. This equates to deductions of $35,840 at 5 years and $50,176 at 7 years. Now, this might seem like it's pretty good, but cost seg is even better. Let's check out why. Now, I'm not going to go into every number listed on this slide, but please feel free to pause the video at any time if you want to dig further into it, or contact me if you do have any questions. For the same property, let's say we're able to determine that you have $100,000 in plumbing and flooring, $75,000 in electrical, and $100,000 in curbs, sidewalk, and storm drains installed as part of this property. We also know that the usable lifespan of these items is not 39 years. So with this information, we can break these items out into the 5, 7, and 15-year buckets of time that we mentioned earlier. Our 5-year bucket will contain plumbing and flooring, our 7-year bucket will contain electrical, and our 15-year bucket will contain curbs, sidewalk, and drainage. To determine the depreciation at each time point, we can divide the total cost by the number of years in your bucket, then multiply by your tax rate. So for example, let's look at the 5-year bucket. $100,000 in total divided by 5 years comes out to $20,000 per year. $20,000 times a 35% tax rate comes out to $7,000. Now we can multiply that by each additional point in time that we want to look at, which will be 5 and 7 years for this example. But remember, we can't take additional depreciation on items that have been fully depreciated. So that's why the same number is listed for both 5 and 7 years for our 5-year bucket. Think of it as once the bucket is emptied, we can't fill it back up. Remember, these are the same points in time that we used in the conventional depreciation example. If we look at each bucket for cost seg, at these time points, we have a taxable deduction of $13,083.33, $65,416.67, and $77,583.33. So let's compare that to the same time points with a traditional depreciation schedule. So to recap, instead of depreciating the entire building on a 39-year schedule, we've broken out about 35% of the depreciable items into these buckets that we keep mentioning. So what did this do for us? We've taken items that we know don't last through the full depreciation schedule and put them into essentially what can be considered their proper categories. The remaining 65% of these items can stay in the normal 39-year schedule. This allows you to still have future write-offs without blowing through the depreciation for your entire building. That's a win-win, right? Well, let's check out the table. So when we compare cost seg with traditional depreciation in this example, you can see that cost seg gave us an additional cash flow at 1, 5, and 7-year time points. Check out year 5. That's a huge difference, almost $15,000 that you can put back into your business. But for full disclosure, cost segregation is not always going to make sense for everyone or every property. But this is why we provide our clients with a no-cost tax savings projection. You can then determine if this is a good fit for your strategy with no strings attached. So if this seems like something that would be a good fit for you and your business, you can visit my website at strussconsulting.com and get a hold of me by phone at 484-488-7982 or by email at adam@strussconsulting.com. See you guys in the next one.